Ladies and gentlemen, it's a real pleasure to welcome you to the webinar of the Belgian Financial Forum on the review of Solvency II. You all know that Assuralia is a highly appreciated partner of the Belgian Financial Forum, and this colloquium was prepared in cooperation with Assuralia. We sincerely thank Mrs. Vernaillen, the President of Assuralia, for this very fruitful cooperation. This webinar will focus on the review of the prudential framework for insurance companies. It is organized at the most appropriate moment, namely at the end of the consultation process. But more than that, the panel of speakers is really outstanding. We can offer you a webinar with representatives of three key role players in this field, namely EIOPA, the European Commission, and Assuralia for the Belgian scene. It is not my role to go into the content of the webinar. For that, we have speakers who are far more competent and far more well-speaking than I am. But I give you a short overview of the program. In the first part of the webinar, Mr. Justin Wray of EIOPA will focus on measures to improve the EU-wide harmonization of rules of financial stability. In the second part, Mrs. Vernaillen will bring the viewpoint of the Belgian insurance sector. And in the third part, Didier Millerot from the European Commission will bring us the viewpoint and propositions of the European Commission and will certainly focus on certain aspects of the Capital Markets Union. Finally, ladies and gentlemen, I am very happy to introduce you Mr. Jean Hilgers, who will speak out the introduction for this webinar. Jean Hilgers is Executive Director of the National Bank of Belgium, and he is also the Chair of the Belgian Financial Forum. His responsibilities in the National Bank of Belgium on prudential issues are very important. He is in charge of two relevant services, namely the Financial Stability Service and the Prudential Policy and Inspection Service for insurance companies. So before giving the floor to Jean Hilgers, I have two practical announcements. We organize a Q&A session via the chat function of MS Teams. During the conference, you can introduce questions, and a selection of the questions will be presented to the speakers after the conference. Second, we intend to register this event, and if possible, the registration and the PowerPoints will be available on the website of the Belgian Financial Forum and of those of Assuralia. So I think this is it for my introduction. Mr. Jean Hilgers, please take the floor.
Thank you, Mark. Ladies and gentlemen, thank you for attending this webinar on the Solvency II review. I think this is a welcome and timely topic. We all know that a healthy insurance sector is essential for the functioning of market economy, as it contributes to economic growth, financial stability, consumer protection as well. But one of the preconditions to make that work is the availability of an efficient and comprehensive regulatory framework. And the Solvency II directive, which originally dates back to 2009 and became applicable early 2016 onwards, marked a major step forward in the prudential framework for the industry. Solvency II improved the rulebook in many ways by introducing an EU-wide harmonized regulatory regime, enhancing balance sheet valuation, making it market consistent, introducing risk-based capital requirements, aligning governance and reporting requirements for insurers up to the highest standards. And these improvements have helped enhance policyholder protection and have also contributed to financial stability in the Union. So, for those of you who still remember that, the introduction of Solvency II was a challenging process. In an environment then characterized by the financial crisis 12 years ago, some of the Solvency II basic principles came under clear pressure, even before the introduction of the framework. Especially the volatility observed in the financial market, induced first by the financial crisis, then a few years later by the sovereign crisis, raised the question whether a market and risk-based regulatory framework would be or not be conducive to excessive procyclicality and volatility. And in an attempt to strike the right balance between the risk sensitivity of the framework on one hand, and the willingness to avoid prompting artificial volatility in the system on the other, Solvency II directive saw the introduction at the late stage of the long-term guarantee package, the LTG, during the final steps of the negotiation. Now, at the time Solvency II was finally introduced, policymakers and supervisors knew that the fresh framework would probably not be perfect from the start, and experience need to be gathered, and hence the possibility of an extensive review was immediately embedded in the system and in directive. And this review has been and continues to be one of the major projects for EIOPA, as well as for national supervisors involved in this process. And an important next step here from a supervisory perspective is EIOPA's opinion on the review and its advice to the Commission. And of course, COVID-19 has brought extra challenges in this process by delaying the delivery of this EIOPA opinion from June to December of this year. And we're now approaching this new deadline, and I can tell you that the EIOPA's opinion on that will provide for a comprehensive, timely input to the review process, that's for sure. Now, under this challenging environment, and not only characterized by COVID-19, but also on a more structural note by this low growth, low yield, compressed spreads environment, EIOPA's opinion on Solvency II will be guided by a few key principles. First is to make sure that the new version of the directive properly recognizes the economic context and remains consistent with changing circumstances. And this entails a better reflection of persistently low rates in the calculation of capital requirements. And these low, even negative rates on some maturities have become part of new reality we all face. And sound capital requirements adequately reflecting such interest rate and yield curve, compressed yield curve, should be one of the cornerstones of the Solvency II review. Second principle is to make sure that all changes are overly balanced as to their average impact on the capital requirements of EU insurers. And as a consequence, the fundamental principles of the directive are not questioned, and the approach followed for the current 2020 review has been one of more introducing an evolution in the system rather than a revolution. Now, on the other hand, there should be no room for complacency, and we all see interlinked areas of significant concerns which have been identified in previous years. And this review should be used to address these shortcomings and to come up with efficient solutions. And within the second principle, the objective is to align the long-term guarantee measures with their initial regulatory objective, which is to preserve the availability of long-term guarantees in insurance products, the current stance, but also going forward, and to introduce an appropriate treatment of long-term investment, which are used to back long-term liquid liabilities. Now, the challenges addressed by the review are extensive and of varying nature. To provide you with a few examples, we have within the balance package, the review tries to improve the economic representativeness of the term structure of risk-free rates, especially those used for discounting long-term liabilities. Then it also aims at fine-tuning the volatility adjustment, the VA, by mitigating its potential overshooting, undershooting effects experiencing, especially at the onset of the crisis, we experienced that. And we need to find adequate ways to solve this while avoiding cliff edge effect, especially from moving from the European portfolio to the national portfolio in case of widening spreads. Another example is that the review tries to enhance the effectiveness of long-term equity submodel used in the calculation of capital requirements in an attempt to incentivize insurers to hold more equity position than it used to be. And we know that it's a clear shortcomings of the current review, of the current framework, sorry, is that the position in terms of equity is clearly disappointing and need to be addressed. So striving for a package of changes which is ultimately balanced while improving the overall framework in many ways is clearly not an easy task, but one which EIOPA and all EU supervisors aim to achieve. Finally, a third and last principle is to further complete the regulatory toolbox for insurers to allow supervisors to act at sector-wide level using an underlying macro-prudential reasons. And by promoting this, we clearly here have a focus on first an EU-wide recovery and resolution regime for insurers. Second, also to highlight the need for macroprudential policy requirements that exist for banks, for instance, but in a way adapted for the insurance business. And EIOPA's opinion here will help finalizing the remaining cornerstones of the prudential supervision framework in this way. On the recovery and resolution side, the idea is to provide legal certainty when the insurer runs into difficulties, reach the point of no availability. and should ensure that any failures, especially of big players, happens in an orderly way. By introducing macroprudential policy requirements and tools, the idea is here to explicitly target systemic risk, and supervisors here should look beyond individual insurers' position and implement market-wide measures when needed, especially to address systemic risk and spillover effect. So these key principles applied by EIOPA should help make sure that Solvency II remains one of the most innovative framework in insurance supervision. And the timing and final design of the updated Solvency II framework should, of course, take into account the current COVID crisis, and that is quite uncertain, whose duration, magnitude are still unknown. But at the same time, we think we need to go further than that, and the timing of the review also provide for a unique opportunity to take on board the needs and requirements related to other key projects of the union, such as the capital market union. And as natural long-term investors, insurers could be well equipped to provide their natural candidate to provide long-term funding to the economy. And so balancing the needs and requirements of capital market union with consideration of the evidence-based prudential framework will again be an interesting challenge for supervisors and policymakers going forward. And finding this balance will undoubtedly bring us back to one of the recurring core questions of the Solvency II framework from the outset, which was the idea of how can we make sure that this green-sensitive regulatory framework we want to have and we have today can still provide for the necessary stability of the system of long-term investors like insurers to be able to provide long-term financing to the economy. And especially in time of crisis, I think this question is all the more relevant. So, ladies and gentlemen, let me stop here. I've been long enough. And this consideration, I hope you have unlocked some food for thought for you. And I hope you will enjoy this webinar. I'm pretty sure the list of distinguished guest speakers we have today, Justin from EIOPA, Hilde from the industry, Didier from the Commission, will provide you with more thought-provoking, up-to-date insight into the Solvency II review process. I hope you will find this webinar useful and you will enjoy that. And with this in mind, I give you back the floor to Mark for the rest of the webinar. Thank you.
Thank you, Mr. Jean Hilgers, for your food and for thought. Now let's go to the first speaker of this webinar, Mr. Justin Wray. We are very happy to welcome you in this webinar. And from EIOPA, Justin Wray is head of the policy department and head of the insurance policy unit of EIOPA. Before joining EIOPA in 2011, he worked at the UK pensions regulator, and therefore he worked at the UK Treasury on financial services regulation. So he holds a master's degree in economics from the universities of Southampton and Warwick, and an MBA from Cranfield University. So I think, Mr. Wray, you are the right man on the right place. I give you the floor. May I ask you to speak loud and clear for our audience, and I thank you. I give you the floor, please.
Thank you very much, Mark. And I hope you can hear me. I will talk as loudly and as clearly as I can. And of course, I want first to thank the Belgian Financial Forum for this opportunity to speak. It's a pleasure. I want also, since I've had the honor of following Jean Hilgers, to just emphasize in particular the quality of the Belgian contribution to EIOPA's work. Jean is the chair of our Risk and Financial Stability Committee, and as you might expect, they have been busy, to say the least, in the last 9 months or so. But he has done a great job leading EIOPA through the COVID crisis, but also in areas such as pensions and consumer protection. The Belgian contribution is extremely valuable, and I wanted to start by thanking our Belgian colleagues for that. In terms of what I wanted to talk about, I'm clearly going to cover the Solvency II review. I want to cover the approach to the review. What are the EIOPA's objectives for the review? Touched already by Jean, but I will elaborate a little bit. I will say something about the measures that we are intending to recommend to the Commission under the review. I will say something about COVID-19, and I will finish off by saying something about process and timing. So if we can move, please, to the slide which says the review of Solvency II was always foreseen. John mentioned this, and of course he was right, that Solvency II was introduced during difficult times, the global financial crisis, other events, and that, as he said, I mean, firstly, that the long-term guarantees measures were a response to events at that time, and secondly, that in order to get agreement of the Solvency II directive in the first place, there was an undertaking that there would be a review in 2020. So we always knew we were going to do this. The slide sets out some of the areas in the legislation which were required to be reviewed, and you will recognise some of those already. Something like the SCR review, for example, was looked at by EIOPA in 2017-18, and then and the Commission introduced legislation following its assessment of EIOPA's advice. Likewise, we looked at group supervision and capital management under Article 242 of the Solvency II Directive, and we will say some more on groups in the opinion. If we could move, please, to the next slide. Evolution, not revolution. John's already mentioned this, and this is the approach. It is the approach because we believe that the structure of Solvency II remains valid, that the three-pillar approach of Solvency II is correct. Moreover, when the Commission asked us to provide advice, they were clear that the fundamental principles of the Solvency II directive should not be questioned in the review. So, although there is a lot to look at, as I'll come on to say, on the other hand, we believe that the structure of the system is essentially working well, and therefore it should be an incremental rather than discontinuous approach. If we may move on, please, to the slide which says, well, the second slide about evolution, not revolution. Moreover, we think that implementation has been a success for the reasons in the slide about better alignment of capital, better risk-based approach to risk management, strengthening of governance models, greater harmonization both of what is reported and the way in which it is done so. And indeed, Solvency II is also a model for many other parts of the world. That through EIOPA's international work alongside the Commission, there are a number of countries all over the world which are also have introduced or are introducing Solvency II-like systems. In other words, it is a framework which is generally thought to be modern, to be appropriate. It is something that works, and therefore it should be reviewed, but we should kind of remember that the underpinnings are fundamentally good. But of course, life moves on. That the need for a review was foreseen, and of course, in light of COVID-19 and the economic developments which flow from that, it's important to assess the different parts of the Solvency II framework. If we could move, please, to the slide that says 2020 review of Solvency II. The Commission asked us for a broad review of Solvency II. I mean, they specified 19 different chapters for the review. They're listed there, covering all aspects: Pillar 1, Pillar 2, Pillar 3. The deadline is no longer the deadline, the 30th of June. John already explained that. I'll come back to that a bit later. On the bottom of in the bottom box of this slide is related EIOPA deliverables. So the annual reports on long-term guarantees, a key part of the Solvency II framework. A response to an earlier call for information on asset liability management, and of course the opinion on the 2020 review. If we may move on to the next slide on objectives of the review. Again, Jean touched on these. Let me go into a bit more detail. Firstly, that the updating of the current regulatory framework should be done in a balanced way. And of course, this is consistent with the belief that the Solvency II framework has so far been largely effective. It would be a slightly strange position to say, well, we think it's working well, evolution, not revolution, but that in terms of the capital requirements on insurance undertakings, that there should be a huge amount of change either way, whether in terms of increasing capital or reducing it. So, yeah, one of the objectives of the review is that the updating of it should be balanced. The second is the proper recognition of the economic context. We know, of course, we all know that economic growth has been subdued, that there has been extensive monetary easing and a general flight to safety. We know that this situation was moreover further intensified by the COVID-19 pandemic, and that this has had a severe impact, particularly at its start, both on macroeconomic and market conditions. That, for example, in October 2020, almost the entire euro swap curve was in negative territory. But this economic context needs to be recognised in Solvency II, and I think there's two consequences in particular. Firstly, EIOPA is proposing changes to the treatment of interest rate risk, and this was something which we recommended already in our 2018 review of the Solvency Capital Requirement, and we continue to propose it. Secondly, that we recommend changes to the interest rate curve used by insurers to value liabilities, particularly or specifically in respect of the extrapolation of those curves, and that these changes are a recognition of the economic context. And finally, as it says there, the completion of the regulatory toolbox for insurance, that there is a need to supplement the current macroprudential framework of Solvency II with a macroprudential perspective, including the introduction of particular tools and measures, as well as the need to develop a minimum harmonised recovery and resolution framework, and also achieve minimum harmonisation in the field of insurance guarantee schemes. So these are steps which will, as it says, complete the regulatory toolbox. Let me turn then, please, to the next slide, which says balanced updating. Now, I'm not going to talk about specifically what is in the EIOPA opinion. You have at most one further month to be curious before it is sent to the Commission and published. Actually, it'll be less time than that, because even supervisors like to have a Christmas break. So yeah, it's not for me to say what are the details of what is proposed in the areas on the slide, but let me sort of go through sort of some of the thinking about why these are areas of change. In terms of extrapolation, the clear view is that the last liquid point for the euro of 20 years is inappropriate, that it is leading to under-reserving of technical provisions and incorrect risk management incentives. Having said all that, of course, we need also to recognise the impact of changes to the extrapolation, and to go back to the objective I mentioned before, the need for a balanced updating of the regulatory framework. In relation to the risk margin, I think it is important never to forget that the risk margin is a consumer protection mechanism. It's not an instrument of torture. It enables insolvent insurers to be taken over. This is a thankfully rare event, but it can and does happen. Nonetheless, in relation to the risk margin, we believe that there is steps that can be taken to recognise aspects such as the dependence of certain risks over time. I mean, to put crudely, you can't die twice. That although our previous analysis of the risk margin, in particularly in respect of the cost of capital, was correct, there are certain dependencies which can be recognised and is likely to be part of the opinion. The volatility adjustment. I mean, I think the defects of this are well known to an extent. The tendency for it to bring about both over and undershooting. That there's no reflection in the volatility adjustment of the illiquidity of liabilities. That the country component has cliff edge tendencies, so you get kind of discontinuous changes in the volatility adjustments when the country specific indicator is activated, and that therefore there are steps that can be taken in areas such as application ratios and to look at mitigating the impact of changes in spreads, particularly in the case of long-term and illiquid liabilities. So there will be, the opinion will cover that as well. Equity risk, Jean actually referred to the difficulties of, referred to equity risk, in particular the importance of long-term equity reflected in the Capital Markets Union report and elsewhere. That at the moment there is relatively low take-up of the provision that exists already in respect of a different treatment of long-term equity. EIOPA will make some recommendations in its opinion for changes to this area. In particular, we expect to make more of a link to low equity which is held long-term against long-term liquid liabilities. The lower need for such equity to be called on quickly is capable of being recognised. Proportionality, but this is one of the trickiest areas as a supervisor, but we would expect to look at new processes for applying and supervising the principle of proportionality with the aim of making it more automatic, with the intention of providing more predictability and certainty to insurers, while at the same time keeping the risk-based approach. So that is a description of the main components of the balance. Let me turn to the completion of the regulatory toolbox and the slide with the title. So, as always, we intend to include the macroprudential perspective in the opinion. That we call for a minimum harmonised and comprehensive recovery and resolution framework and the minimum harmonisation in the field of insurance guarantee schemes. Let me turn to COVID-19. So we turn to the slide which says COVID-19 response supervisory measures. We know at the time that the COVID-19 outbreak caused significant disruption to the economy, business and people. We know that, we all know in our different countries that this disruption continues. EIOPA kind of worked closely with the Commission, with the national supervisory authorities to look at mitigating the impact on the insurance and occupational pension sectors. And this slide lists a number of the different measures that we took in relation to things like providing more flexibility in the areas of reporting and disclosure, more frequent publication of key EIOPA information. Let the next slide look at draw attention to a couple of key statements. One of those is the statement on dividends distribution and remuneration practices of the 2nd of April, and also the call to action for insurers and intermediaries on mitigating the impact of COVID-19 on insurers. So, if we could move, please, to the next slide, process and timing of the review, then to the next substantive slide. Information requests. I mean, the Commission quite rightly said, please assess the impact of any changes that you recommend in your opinion. And moreover, they said, look at the impact not just of particular measures, but look at the impact of the review as a whole, and also get some idea of how that impacts in different member states. And of course, to do that, we had to ask insurers for information. So those of you who are insurers who are listening, thank you. Thank you from EIOPA for participating in the information request. And you know, some of the sort of positions, some of the sort of specificities of that request are put there. That of course, until you have the information, that the position on the review should not be final. That we seek that they have a representative sample, and that different scenarios are tested. That was what you might call the first information request. Then, of course, along came the next slide on the complementary information request. On the 30th of April, EIOPA recognized that the holistic impact assessment, the first information request, which sought data as at the end of 2019, was not sufficient to make a judgment about what were the appropriate measures given the COVID situation. So we did another information request with the details here on the slide, trying to capture the impact of the COVID situation. So the reference date was the 30th of June, as those who took part in the information request will of course know. And if we move on then to my final slide, these steps led to a change in the timing of the advice. It was scheduled for the end of June. Now it is the end of December. So the end of this month. In terms of assessing that timing, we essentially had a one-shot deal, if I can put it like that, in terms of the review. There was a legislative process which had to be followed in terms of the review of Solvency II. In other words, the review of Solvency II was going to happen anyway. We wanted to reflect the impact of COVID, but we couldn't wait forever to see, to let the COVID situation play itself out over a very long period of time. So, what the new deadline of the end of December enables us, hopefully at least, to capture some of the impact of the first part of the COVID situation, so that the opinion is kind of can reflect that. Final bullet, of course, is very important: engage with all stakeholders in a transparent process. We consulted on the review as a whole. In terms of thinking about changes relating to COVID, we of course had a large stakeholder event to take everybody through those changes, and we hope that the consultation process, the impact assessment, means that we have sort of engaged interested stakeholders on the industry, consumer, and other sides to the extent that is possible. So, final slide. Thank you for your attention. Thank you for listening, and we look forward to sharing the opinion with you by the end of the month. Thanks very much. Back to you, Mark.
Thank you, Justin, for your contribution. Although the technical quality was not ideal, very, very much thank you for your contribution. Let's go to the second part of the webinar with Hilde Vernaillen. Hilde Vernaillen is very well placed to give us the Belgian point of view from the Belgian insurance sector in two ways. First of all, Hilde Vernaillen was appointed executive president of the executive committee of PNV Insurance, although in 2011. And this year, since begin this year, she was elected president of Assuralia, the Belgian insurance sector. So Hilde Vernaillen is very well placed to give us the Belgian point of view. Hilde, the floor is yours.
Thank you, Mark. Good afternoon, ladies and gentlemen. First of all, thank you for giving me the opportunity to speak to you this afternoon in such a distinguished panel. And thank you to the Belgian Financial Forum, and especially to you, Jean Ilgers, for organizing this webinar and giving Assuralia the possibility to share its vision about the future of Solvency II. Let me start with a strong statement, is that the insurance industry is today really supporting the Solvency II framework. The economic risk-based framework has proved its value since it was put in place. And even if a few things were already said by Jean Ilgers in its introduction, I would like to start by reminding you some of the key strengths of Solvency II framework. It's important because some of those strengths, of course, already shows their deficiencies. So it is important to deal with that in the review of Solvency. Solvency II introduced a risk-based framework for supervision. As you know, it was based on a total balance sheet approach for the risks of all assets and liabilities, which was completely different with the previous framework. And the result is a capital requirement aligned with companies' risk profile. And this is reflecting an adequate level of prudency. Furthermore, Solvency II introduced a market-consistent valuation for almost all assets and technical provisions. This means that changes in the market value of the asset portfolio are directly reflected in the company's solvency position. A consistent methodology has been developed for the valuation of technical provisions using a risk-free rate for discounting. And Solvency II also introduced strong governance requirements, transparency. And in the beginning of Solvency II, I tended to say that this was the most important part of Solvency II. The ORSA brought more focus on companies' risk management and governance up to the level of the board of directors, and this was completely new. So more transparency on the risk, profit, and solvency positions has been realized through enhanced public disclosure on companies' websites. And then the reverse of the medal, there are also some shortcomings of Solvency II. These shortcomings have become clear over the past years, and most of the points are well known by industry and by the supervisor. The first problem relates to the excessive volatility Solvency II creates on the balance sheet. While Solvency II provides a good indicator of the financial condition of a company in normal market situations, it risks providing wrong signals in the solvency position in situations of heavy market turbulence, and we have had some of those in the past years. So Solvency II provided solutions to deal with this problem, in particular the matching adjustment followed by the volatility adjustment, but these solutions are only partial and not adapted to the specific asset and liability mix of the Belgian insurance companies. As a second shortcoming, Solvency II creates some strong disincentives for long-term investments, and it was addressed by the previous speaker. For corporate bonds and loans with long durations, the capital requirements are very high. And due to the excessive short-term focus of Solvency II, the real risks of illiquid long-term investments are exaggerated and form a constraint for the long-term business of an insurance company, and especially, again, in the Belgian market. As a result, asset portfolios tend to become more concentrated, Examples are the growing portfolios of government bonds, real estate, and mortgage loans. Thirdly, Solvency II has led to excessive levels of reporting. And risk departments in insurance company are nowadays so busy conducting risk administration that barely time is left for real risk analysis. For instance, hundreds of qualitative templates and dozens of qualitative reports need to be prepared by all insurance companies with only a limited application of the proportionality principle. And are the reporting obligations in balance with the effective use of these documents? This is, to me, a big question mark. So let's now turn to the revision of the framework, and I will go to the objectives of the framework, and I classified them in 5 key objectives. Justin, you had a slightly different classification of this, but everything is consistent, I do believe. So work in progress, and we try to deal with the shortcomings in that revised framework, of course. Justin said it before, it is the purpose that the overall should lead to a balanced package for the industry. And it is challenging to find solutions that are workable for many different markets, many different kinds of insurance companies. For the Belgian market, the impact assessments, even if overall balanced, have produced mixed results. The first objective of the revision is to obtain a more reliable measurement of the capital requirement. And to this end, improvements to the volatility adjustment have been tested that are useful, including rescaling fixed income assets to be 100% of portfolio, improving country component, changing the general application ratio, including a duration adjustment in the application ratio. However, also modifications to the volatility adjustment have been tested that are questionable, including changes to the risk correction and the introduction of an illiquidity adjustment factor. So changes would make the volatility adjuster more pro-cycle and less effective in stressful situations, and together this would neutralize the improvements. A wide series of measures have been tested to deal with potential problems of excessive volatility on the solvency balance sheet. For example, improvement to the country adjustment, the introduction of a macroeconomic volatility adjuster, and own assets volatility adjuster. And based on the impact assessments, the preferred solution of the EU level seems to consist in adaptations to the country component. At this point, it is important to underline that these adaptations would not solve the volatility problems for the Belgian and Dutch insurance companies. However, we are confident that a solution can still be found, for instance, in a further adaptation of the country component of its triggers in order to make it work also for the Belgian companies. We do not only need a reliable measurement of the capital requirement, it's important, but also an appropriate valuation of the liabilities. As a complement to the best estimate, the risk margin should lead to a realistic value of technical provision. As you know, due to the low interest rate environment, the risk margin of several insurance companies has increased to considerable levels. Unfortunately, not so much the volume of technical provisions, but rather their duration strongly impacts the level of the risk margin, disincentivizing long-term business. Just as an example, the risk margin currently reduces the risk-taking capacity of the Belgian insurers by up to 5.3 billion euro. EIOPA has been looking at revisions to the design of the risk margin and tested the introduction of a lambda factor. However, these changes have only a limited impact. Therefore, the Belgian insurance sector believes that a re-examination of the cost of capital is needed. Another key component to calculate the technical provisions is the risk-free rate. Over the past years, the methodology to calculate the risk-free rates has been adapted several times. No further changes are deemed necessary now. The methodology already reflects current low interest rates, including negative rates when they occur. A change to the extrapolation methodology risks creating another source of artificial volatility and would make it even harder for insurers to offer long-term insurance and pension products. More generally, it's important that the risk-free rate should be a stable and predictable measure, not a measure that can be changed year by year. As a third objective, the review should increase insurers' capacity to invest and take on risks. With Solvency II, heavy capital requirements have been introduced for corporate bonds and loans with long durations, and for equity. As a direct consequence, insurers' financing of the real economy has been seriously restricted. This is unnatural, as insurance companies traditionally have been providers of long-term financing to firms and corporate institutions through equity, bonds, and loans. Unfortunately, in the assessments of EIOPA, no real solutions have been advanced to solve this problem. However, this should not be a reason to leave the heavy capital charges for corporate bonds and loans unchanged, as this will significantly limit insurers' capacity to invest in sustainable projects. And we do need sustainable projects in our economies. Possible solutions to deal with this problem could be to allow the use of the dynamic volatility adjuster to apply also for the standard formula users. For sustainable investments, the sector is not in favor of the introduction of artificial incentives or disincentives to hold assets based on green or brown qualifications. The capital requirements should remain risk-based and consider the real risks of sustainable projects. Not different treatment is requested here. While lower capital requirements have been introduced for long-term equity last year, there is still a lot of uncertainty about the qualifying criteria. Criteria need to be improved so that a significant amount of equity investments can qualify as long-term, thus removing a barrier to greater investments by insurers. And as a fourth key objective, the sector is asking for a less burdensome framework. And this means less burdensome in terms of reporting and more proportionate considering companies' nature, scale, and complexity of their activities. With regard to the reporting, it is requested to reduce the periodic quantitative reporting templates. It's more than 2,000 files a year. I mean, this could probably also reduce the work of all people that need to review that at a European level. EIOPA has conducted extensive analysis of the reporting templates, but we fear that this will lead to the wrong outcome. Of course, some changes are to be expected. However, the sector is not in favor of the introduction of a large set of new QRTs and implementing a numerous small changes to the existing QRTs. That would be really counterproductive and not render the reporting obligations less burdensome. Indeed, all those adjustments, even small ones, are costly because the reporting is mostly computerized. Next to this, amendments to the legislations are requested to ensure proportionality works in practice. The amendments should facilitate the application of the proportionality principle, one of the hallmarks of the framework. A solution could be creating a set of proportionality measures with predefined risk-based criteria for their automatic application. This should allow the requirements to become more commensurate with the risk profile of smaller and medium-sized companies. And last but not least, the review should lead to a more efficient insurance market. That's only possible by targeted legislation that aims to fix real problems and supervisory tools that are applied in a proportionate way. A harmonization of some macro-prudential measures at the European level can be useful, of course. For instance, supervisors should be able to temporarily prohibit the redemption of policies in specific circumstances for a specific company in distress. However, the sector is not in favor of the introduction of new intervention powers before the CSR is breached. The Solvency II framework was designed for early intervention, which starts as soon as the SCR is breached. There is no need for new powers for even earlier intervention. Likewise, the sector does not understand the need to introduce counter-cyclical capital buffers or capital surcharges for systemic risk. Such proposals give the false impression that the insurance sector is in serious difficulties and that capital reinforcements are necessary. Whilst in fact, most companies have maintained very acceptable levels of capital during this unprecedented crisis. Such measures would directly increase the cost of insurance operations and would in consequence increase the barriers for long-term projects and investments. I do thank you for your attention, and I'm of course willing to discuss this issue further with you at any time. Thank you.
Thank you, Hilde, for formulating very clear and very documented the position of the Belgian insurance sector. I want to invite Didier Millerot for the third contribution to this webinar to comment on the position, the point of view of the European Commission and the propositions that are formulated by the European Commission. To have a situation of Didier Millerot, he was appointed in 2019 head of the Insurance and Pension Funds Unit of DG FISMA, and before that he was active at the cabinet of Commissioner Barnier, and he joined DG Market in '97. So Didier, the floor is yours.
Thank you very much, Mark. And thank you in particular to Belgian Finance for inviting me today indeed, and to be able to present the state of play and the perspective of the European Commission on the Solvency II review, and thanks also to Hilde and Justin for their views on that. It's also very useful for me to hear that. I will indeed, as I said, present the state of play of our thinking. The big difference between me and Justin is that Justin is nearly finished his job, while I still have a lot to do with this review ahead of me. So if someone could please go to the next slide. Yes. Let me first give you a few, tell you a few words about the general context under which this review is taking place. I have to say that the previous speakers have said it all, but Solvency II indeed is, let's say, in force since 2016. So there is a legal mandate to review it. But of course, it's also, let's put it that way, a better regulation, good practice to look at the way such an important piece of legislation has been working and make sure that it remains fit for purpose. And it is in that spirit that we, of course, are looking at this review as well. An important message also, and a feeling which I believe I share with the previous speakers, is to say that we have a robust framework, and the COVID crisis, as it did confirm that this is the case. It was much better to go through the crisis of that magnitude with a solvency regime like the one we have in the EU, thanks to Solvency II, rather than doing that without it. So that is something which we can be proud and we can be reassured about. But as Jean, I think, said as well, it's not a reason to be complacent. And we need to look at the way that's been working in the past. And when things can be improved, then we should, of course, improve them. That's for the context. An element which has not been mentioned so far, but which we believe is important to present as well, is the fact that we are going to, let's say, tackle with you in a comprehensive way, in the sense that, as you know, the legal architecture of the Solvency II framework is basically made of two pieces of law. You have the directive, what we call the level 1 directive on one hand, and the delegated regulation on the other. The delegated regulation is based on the directive, but as we know, it complements it. So it's difficult to, let's say, apprehend such a review without touching at the two pieces of law in as simultaneous a way as possible. The difficulty, however, is that they are not subject to the same, let's say, legislative process. So we will need to find a way to synchronize the two procedures. But I think the main message for my presentation today to you is to tell you that the discussion will indeed cover the two bits. So that's for the first slide. So now a word of allow me, contrary to Justin, to start with timing, and then I will speak about substance. But just to maybe set the scene for you, and maybe to tell you what you can expect between now and the next month. Not to say years, of course, because EU legislative processes, as you may know, are not that quick. But nevertheless, in terms of the next step for next year, obviously, the most immediate one will be the adoption of EIOPA's advice by the end of next year, fundamentally a super important step on the process. That advice will inform to a very, let's say, large part our assessment of the content of the review, but it will not be the only, of course, the only element which we'll take into consideration. The next step, institutional step, will be, of course, the adoption by the Commission of its legislative proposals. And this has been announced for the third quarter of next year in a document related to the Capital Market Union, the Capital Market Union Action Plan that was published on the 24th of September. So the Commission will come out with its proposals hopefully in July, but if not possible, let's say at some point during the summer next year, in a package which will be made, as I said, of legislative proposals, but also a comprehensive impact assessment that is going hopefully to justify the choices which we're going to make in our proposals. But that too will not be the end of the process, in particular as regards the changes to the directive, because those who have the final say in this respect, as you know, are the European Parliament and the Council. So we can expect a legislative negotiation that will start in the second part of next year and probably will continue until at the earliest, I would say, the middle of 2022, and maybe more probably the end of that year, 2022. So it is likely that we will not have a full package adopted and a full package able to start to be implemented before the beginning of 2023. That may sound a bit long, but that's the let's say the time which a normal EU legislative process takes. Let's see to what extent we will be able to accelerate this, but it's difficult, of course, to predict that such, let's say, in advance as today. Let's see what the future will tell in this respect. Next slide, please. So I've mentioned the importance of EIOPA's advice, and I would like to again underline it, and also maybe use that opportunity to publicly thank Justin, his teams and his colleagues, both in EIOPA, but also all those members in the national competent authorities who have contributed to this work, including, of course, the Belgian authorities, headed by Jean, and Jean, you're part of this. Big thank you from my side, of course, but that is, of course, an important element, as I said, but not the only one. And the Commission likes to run its own consultations, its own engagement with the stakeholders. And as you may have seen this year, we organized a conference in January about the Solvency II review. That was right before the COVID crisis started, so we managed to have an in-person conference with a lot of people. And that was good, but already nearly a year ago. And since then, we also have organized our own public consultation that ran during the summer, and for which we had quite a good level of responses, including a response by Assuralia, the Belgian body which represents the Belgian insurance industry, and at this occasion, of course, I'd like to thank as well Hilde for the contribution of our organization in that process. So we'll take all this together to again inform our decision and put together hopefully a solid proposal for a review of the Solvency II framework. So that's for the process. Allow me also now to move to substance. So if you could please go to colleagues to next slide. Something which I call the main themes of the Solvency II review. Why do I use these terms? Obviously because I need to be a little bit prudent at this stage. The Commission has not obviously taken any political decision as to what should be the different elements of the proposals which we're going to present next year, and what should be the respective importance of these different aspects. So what I'm going to tell you now is, of course, by definition exploratory, but on the other hand, it's also based on the debate which is taking place. It's based on the input which we're going to receive very soon from EIOPA. So there's a high likelihood, let's put it that way, that the 5 themes which I'm going to describe now are going to be essential part of our proposals next year. Let me start, please, with the next slide. What I would call the first theme, the first topic, and I think it's as a representative of a political body, I have to start by putting the review into the appropriate political perspective. The insurance sector is, as I think Jean said, a key actor, not only in financial markets, but also in the financing of the economy, but also as a provider of security and risk mitigation. In that sense, it helps the economy work very well. So because of that, it has to play a key role in contributing to the success of the key political objectives of the European Union, which, as you know, are basically the move to a low carbon economy. So this move is going to be accompanied by the Green Deal, which we are trying to put in place at the Commission level, but also by the establishment of a well-functioning capital market union, which an objective which has been, as I said, reaffirmed in an action plan that the Commission published in September last year. So we will need to make sure that the coming review of the Solvency II contains elements which allow the insurance industry to participate to these 2 objectives. So starting with the CMU, of course, I mean, probably the best way for the insurance industry to be able to contribute to the building up or the strengthening of the capital market union is to make sure that we have an appropriate prudential framework and that we have the right incentives to allow indeed insurers to provide for long-term guarantees, to provide their customers with good products. So of course we will have the CMU objective in mind when looking at the different elements of the review altogether. But there are probably also things we can do in terms of providing for better incentives indeed to make sure that the direct financing of the economy by the insurers, in particular in the form of buying equities and buying corporate bond, is subject to the right incentives in the framework. We have already tried to do that a couple of years ago by introducing the concept of long-term equities in the delegated regulation, linking it with a preferential prudential treatment of 22%, linked to the respect of a series of criteria or conditions which we have also introduced at the time. And it's true indeed that we need to see the way this has been used by the insurers, whether it has indeed been successful in providing them further incentives to invest more into the real economy. And clearly the first feedback which we received was confirmed by the consultation and also by Hilde in her address today, is that things are not perfect and the criteria which we have put in place 2 years ago need to be improved. And this is why we have asked indeed EIOPA to look at this, and are grateful for the proposals which we are going to make, which they are going to make for us, and which I believe will be an important element of our proposal next year. So that's one element. Then, of course, I mentioned the sustainable finance dimension, the Green Deal dimension. As I said, difficult for the Solvency II review in the context which is ours at the moment not to say something about it. Now the question will be to determine what are the best ways to make sure indeed that insurers help with the transition to the low carbon economy. This will not be part of EIOPA's advice, but of course EIOPA has worked a lot on the issue already, has issued opinions, And we also have dedicated a large part of our consultation to that issue. So we are collecting views at the moment, and we'll look at the different ways this could be done. Hilde has mentioned her, let's say, hesitations as regards, for instance, the possibility to have green or brown supporting or deterring factors. Obviously, this is something which we're going to look at, taking into account the fact that we have heard a lot of criticism against that approach, but politically this is something which we will need at least to face. But if that is not the right way forward, of course, we'll need to look at alternatives, and alternatives could be indeed around putting in place better incentives for better risk management practices, for instance, by insurers. And this is, in my view, what EIOPA has been working on last year, and it's probably an interesting, let's say, path forwards for us to try again to find ways to green that Solvency II review, again, something which I believe we will have to do. So I would say that it's going to be the first thing we're going to look at, how to make sure that the insurance industry again participate to the major objectives of the major political objectives of the Commission and the EU in general. But of course, that will not be the only thing, and we do not forget what Solvency II was initially made for, which is that it should be put in place a robust and well-functioning prudential framework, and this is the subject of my next slide, please. We need to look at indeed the prudential framework works. As said by previous speakers, the two fundamental principles on which it is built, the market-based valuation and the risk sensitivity of the framework, this should stay. But of course, we need to look at ways to make sure that the tools which have been put in the system to make this function are working as well as we want. In particular, the issue of excessive volatility, which is linked to the market-based valuation framework, which we have, needs to be tackled, and the recent COVID events have confirmed indeed that there is such risk that excessive volatility weighs on the prudential balance sheets of insurers. So we need to see whether the tools which are in place already function correctly, and if that is not the case, we need to see how they can be improved. And that in particular is applicable to tools like the volatility adjustments, which we know very well will be something which we'll need to look at as part of our review. But of course, there are other ways maybe to deal with this issue, and we will look at them in an open way. Of course, on this point, the advice which EIOPA is going to give us is going to be very, very important. Next slide, please. Yes, as I said, it's not the volatility adjustment is maybe not the only element which you will need to look at in this context. Other proposals are on the table, including to adjust the way the risk margin is functioning. I've heard Hilde very well on this. Clearly, EIOPA is going to make proposals to reduce the impact of the risk margin. This is something which, of course, will need to be subject of a lot of attention from our side as well. So that's for the part related to the functioning of the framework in terms of dealing with excessive volatility. The sensitivity to risk is, of course, also important, and Jean in particular has mentioned it. The fact that we are living now in a very, let's say, low interest rate environment needs to be recognized in the framework. EIOPA is going to make proposals in this respect, They're going to be looked at by the Commission as well. And but of course, as I will say later in this presentation, we will of course need to look at how all these elements fit together and what impact they will have on the overall on the insurance industry, something which I will address a bit later in another slide. If you could please move to the next one. Yes, the third theme, which I believe is going to be also quite important, is proportionality. It has been mentioned by several speakers. It's important not only for the insurance industry, but it's something which is at the heart also of the concerns of the Commission. We want financial services legislation to be fit for purpose, to be robust, but also we don't want it to create unnecessary burden or cost for those who have to apply it and those who have to supervise it. So it's good that proportionality is already embedded in the framework. We should maintain that. But the feedback which we receive is that we could do better, and we could do better in particular in terms of how this works concretely and the extent to which it provides for enough predictability and legal certainty for all users. So this is something which we're going to look at in particular, and I'm quite grateful for the impact as well of the coming EIOPA's advice in this respect, with very concrete proposals that are going to be made. Hopefully that will help us indeed to make sure that the proportionality principle works better. Different ways to deal with that. You have the issue of the which companies are actually covered and by the Solvency II framework. So we may wish to look at the thresholds, with the consequence that more firms would be exempted from the obligations of the directive. That would be a first element. But of course, you also need to deal with proportionality as regards firms which are covered, and this is of course something which we're going to look at as well. And then you need to see at the way the interaction between the companies and the supervisor function, what kind of process you use, and on what kind of measures the proportionality can be applied as well. And again, on this, I think EIOPA is going to come with quite a lot of interesting proposal. Next slide is about the fourth theme. It's something which is, of course, at the heart of the Solvency II regime as well, which is the policyholder protection. Again, as I said, for let's say the contributions to the financing of the economy, the first line of protection for policyholders is obviously a well-functioning prudential regime and a well-functioning supervisory regime, and I think we have achieved a lot already in this space. This being said, there are some issues, and it's particularly sensitive in some member states, where issues in particular of cross-border supervision have been noted, with insurers providing services from one country to another, then running into trouble and then not being able to comply with their obligations towards their policyholders, and therefore really create a lot of issues cross-border. So we need to look at ways of improving the way the cooperation between the different supervisors work, and we need to also to look at, should that cooperation be not sufficient, how we could put in place first ways to ensure a smooth handling of companies that are running into trouble. And this is why we're going to look at indeed whether there is a case for strengthening the recovery and resolution regime for insurance companies in the EU, so that we have the same level of protection in the different member states across a single market. And there too, should that recovery and resolution process not be sufficient, we need to think in terms of whether we need or not to let's say have in place minimum standards for the last recourse, which is the recourse to insurance guarantee schemes. They exist in some countries, but not everywhere. And when they exist, the rules governing those insurance guarantee schemes may differ, with the consequence that policyholders across the single market are subject to quite different level of protection. So we need to look at this, probably not with a view to move from a very low level of harmonization to a much more developed or let's say uniform harmonization in the EU. Probably this will be a step-by-step exercise, but this review gives us the opportunity to take such a step and to make sure that we make the policy holder protection agenda in EU progress in the way which is beneficial to all. So that's for the fourth theme. And last but not least, it was also mentioned by previous speakers, financial stability, also an objective of the framework. There too, the quality of the framework is the first line of defense, but we may need more. And we have asked indeed EIOPA to look at this issue in our request for advice. EIOPA is coming with proposals that go a bit beyond what we were, let's say, expecting, but that's their prerogative to do so. And we also have to take into consideration the views of other bodies, in particular the ESRB chaired by Christine Lagarde, who has recently issued papers which are inviting the EU indeed to strengthen the common set of tools which is at the disposal of the different supervisors to deal with the potential creation of systemic risk in the insurance sector. Let's see what will be the result of our analysis in this respect. These are still early days. Obviously, the insurance sector is not confronted to the same risk that the banking sector, so this should not be, in our view, a copy-paste exercise of necessarily of what we have in the banking sector, but we should certainly look at whether there are issues and whether we have a possibility again to strengthen the regime in a balanced way. So that's for the fifth theme, and I would like to maybe conclude my presentation by insisting on the fact that we're going to, of course, look at the merits of these 5 issues, 5 topics individually, but we will, of course, be also very attentive to the overall balance of what we're going to put on the table. This is an exercise which EIOPA has also been carrying out. It was a subject of the 2 data collection exercise, which Justin has mentioned so far. This is also clearly something which is going to be very important for us. We have to recognize that Solvency II has worked well, so there is no need to change things for the sake of changing them. And we also need to see what are the consequences of what we do in terms, again, of the ability of the insurance industry to play its role as service provider, as institutional investor, but also the ability of the insurance industry in Europe, in the EU, to remain competitive globally. So we know that we have quite a good prudential system in the EU, a robust one, something which is largely looked at internationally as a model. But of course, applying such a regime, we know is a costly exercise. So we should be mindful of that when we take our final decisions next year in terms of what will be the overall, let's say, shape, nature and impact of the proposals which we're going to make. That is it for me. Thank you very much to all who have been listening, and of course, like my colleagues, I will be happy to answer any questions. Thank you.
So thank you, Didier, for your very extensive and very interesting contribution to this webinar. Ladies and gentlemen, I think that we had 3 very substantial contributions on the theme of our webinar. I thank, of course, the speakers for their contribution, and I certainly thank the speakers for respecting the time frame that we advanced. Meanwhile, a lot of questions have entered the chat box, and together with my colleague Didier, we selected some questions. We apologize, of course, not being able to give all questions to the panels, but we have selected someone. Perhaps a first question concerning proportionality. The question is, will these possibilities be more documented? Sometimes one can have the impression being dependent on the goodwill of local national authorities. This is a question addressed certainly to Hilde Vernaillen for the Belgian situation or the impression, but also a question to the supervisor. In that sense, that is formulated, what are the experiences of applying the principles of proportionality at the national supervisor? Who will take that question, please?
Maybe I can react first on that perception of being treated differently by the local supervisor. Not really think it's being treated differently, but it's not easy to apply for a proportionality regime because there are a lot of different criteria. So that was our request as a sector, just make it a little bit simpler so that it's quite clear who can apply for proportionality rules and apply them automatically then if they respond to some criteria. That was our point.
Could I say something here, please, Mark? It's Justin Wray from EIOPA. I mean, of course, we don't have one supervisor of insurers throughout Europe. We have 27, and of course you have 27 supervisors, and there's going to be differences in the culture and approaches between them. But what I can say in terms of what EIOPA is seeking to do in proportionality is, firstly, one aim is to make the application of the proportionality principle more automatic, so providing more predictability and certainty. Secondly, we propose to publish an annual report on the application of the proportionality principle per member state. So, of course, if there were to be very significant differences, then that is the sort of thing that might be captured in that report.
Mark, u staat nog op mute.
Sorry, my phone was muted. A question for Justin. Could you detail EIOPA's view on the risk margin in Solvency II? Will there be any changes in the risk margin calculation in EIOPA's advice to the European Commission compared to the current situation?
Yes, there will be changes. They will be on the basis of what was previously consulted on, this idea of the introduction of a lambda factor. In terms of the precise dimensions, of course, I have to ask you to be patient for just a little bit longer until the final opinion is published.
Okay, we received a question for Didier, addressed to Didier, but perhaps also to Justin. To what extent will the Solvency II review influence or not convergence to ICS, so the insurance capital standard. Is it an objective to have both? Is it an objective to have both frameworks in the same direction?
Thank you, Mark. Firstly, the ICS is not there yet. There was a draft standard approved in the IAS last year in the Abu Dhabi meeting, but that standard is now subject to a 5-year testing phase or 5-year monitoring period. So to make sure it is appropriate and make sure that it creates the intended say effect or impact globally. So we will not have a final assessment about that standard before 2024. We are basically free in the EU to decide what to do with our own framework in the meantime. But of course, that would mean taking a bit of risk should that framework be so different from what we have in the EU that we would then run the risk of, once we have finished our review, then have to go back to the drawing board again to adjust it to make sure that it becomes compliant with the international requirements. But fortunately, that is unlikely to be the case because the ICS, as it is currently conceived, is, as I think is quite largely recognized, largely convergent, at least with what we have in the EU. And this was also I would say, the objective of the EU members of the EIS when they negotiated that text. So there is a very limited risk indeed of divergence between the two. But I think what is key to have in mind indeed is that we have a free hand. We can regulate our sectors without having to say present accounts to the international standard setters before 2024.
Okay, thank you. So another question for the European Commission. Do you already have an idea of which elements of the review will go into the level 1 text and those which will go into the level 2 text? And what is it expected that the level 1 and the level 2 text will be applicable? Could you give us some insights? 2 factual questions.
Factual, but quite important, I understand. Yeah, we have an idea, but we have not made a precise analysis yet for the simple reason that we need first to get EIOPA's advice on what would be possible changes to the framework. We know that there will be a little bit of both, quite a lot of prudential rules in terms of calibrations, in terms of formulas are indeed in the delegated act. And these issues, although quite technical, we know are seen at least by stakeholders are being extremely important. So we need indeed to look at the whole thing in a global way, and in particular to further a bit elaborate on what I said previously. If we want to keep the overall package balanced, so we cannot afford to separate the two. Now, in terms of how the two processes will be synchronized, it's a bit difficult to predict. What we envisage, at least, what we would like to see happening is that changes to the level 1 and changes to the level 2 would more or less enter into force at the same time. But of course, that's our current idea, and at the end of the day, we'll need to know as well what will be the intention of the co-legislators, because they will have, of course, at the end of the day, the final say on all this.
Yes, thank you. We received a question for Justin, addressed to Justin, but other speakers, of course, can intervene. Several insurers were able to use the long-term equity submodel, especially for equities held at least 5 years or illiquid funds. What can we expect to be changed in this submodel? If long-term equity criteria are changed significantly, will there be a transitional period foreseen?
Okay, thank you for the question. Although the question said that a lot of undertakings were using the long-term equity, the current long-term equity provision, the evidence is that if you look at the extent of holdings of long-term, the extent of use of this provision compared with insurers' overall holdings of equity, actually the proportion is quite small. And that was one motivation, of course, I think, for the Commission to ask us to look at this, particularly given the importance which is constantly stressed of long-term investments. Are there improvements that can be made? And yes, we will be recommending some changes. I think, as I already noted, in particular, to make more of a link between those long-term equity investments which are held against long-term illiquid liabilities. And there will be a number of other changes to the recommended to the Commission to the existing provision. That may make some difference to the extent to which the long-term equity provision is used, but I wouldn't necessarily sort of say that it has to make an instant impact. What it does is potentially create the conditions for more investment in long-term equity rather than the equities which insurers currently hold qualifying. There was a question about whether there will be a transitional. I don't expect that we would recommend such a thing. Sometimes transitionals are used more generally as solutions to problems in terms of getting from one place to another. I'm not sure that we see such a case on this occasion, but it's always, of course, a possibility. Thank you.
Yes, thank you. A question not specifically addressed, but it refers to the Belgian situation, so perhaps it will be addressed to Hilde. We see more and more government guaranteed loans coming to the market. The guarantees range from 50% to 100%. It is clear how a 100% government guarantee works. My question concerns how the standard model should treat partial guarantees in the capital treatment of such holdings. Is that a question for you, Hilde?